in the markets. Let's bring in Bob Elliott, CEO and CIO of Unlimited Funds. Bob, great to have you back on the show. In the past, you have been cautious around equities. You've talked about cash and keeping up part of your position in cash. I wonder, given the rally we've seen, and yes, we finished the day lower on the major averages, but just given the fact that the S&P has finished the week higher for the fifth straight week, the last time we saw that was November of 2021. Have you been participating more in this? How are you thinking about it?
Yeah, well, I think when I was talking about cash, what I was talking about was looking at cash relative to all financial assets. And that's been a trade that's basically been flat over the course of the last 6 weeks. The thing that's been going on that's been meaningful is stocks outperforming bonds. And the reason why that is because we're in this environment where the Fed remains a couple steps behind. And that was reinforced this week with their commentary. The result of that is that you're continuing to see liquidity move into stocks that benefit from continued reasonable growth and elevated inflation. And you see a particularly bad environment for bonds, which suffer from the need for higher monetary policy and continued elevated inflation pressures. And so it really is a stock versus bond story more than it is a cash versus asset story that we're seeing. So
in terms of the story that you just laid out, how much does it persevere beyond the next 2 weeks where we are seeing rebalancing and we're seeing institutional money basically go to work in equities right now as we do come up on the end of the quarter?
Well, I think the main question is how long is it going to take before we start to really meaningfully cut back the liquidity in the system? And at least so far, what's going on in the overall picture, like you have Kava, the IPO goes up 100% on the first day. That's not an environment where money has become tight. Right, there is still this incredible flow of liquidity that is flowing from one interesting small bubble to another, whether it's NVIDIA or whether it's the newest IPO, et cetera, et cetera. And until we see a point where the Fed starts to get ahead of the curve, where they start to actually tighten sufficiently to slow the economy and bring liquidity down in the economy, you're not really going to see much of a change. And so I'd expect to continue to see stocks outperforming bonds over the course of the next few months until the Fed starts to really move in the way that they need to.
Okay, you don't expect that. At the same time, we've got some challenges in the second half, I would think, because you've got a consumer that's slowing a bit, and we've got Q4 coming up. Then at the same time, last year's second half was rough on the market. So which outweighs which?
Yeah, there's still a lot of momentum in the system. I think that's the important thing to recognize. If you look at, overall growth, we're still looking at or above potential. Unemployment rate is still basically at secular lows, and income growth remains pretty strong, 5-6%, depending on how you measure it. That's a pretty good environment for consumers. Now, of course, there are a few things coming up in terms of, like the restart of student loan payments. But that's going to be pretty modest, pretty targeted. We're talking about a few tenths of 1% of GDP from that sort of restart. And you're going to see continued, a slight pickup in issuance. That's probably going to be a bit worse for the bond market than it is for the stock market. And so, at least for right now, when you look even at the most cyclical parts of the economy, manufacturing is still kind of growing a bit. Housing is rebounding a bit, it seems. Things are not lining up the way they would if we were starting to move into a relatively, acute recessionary environment. Instead, it seems like if anything, things are picking up a little bit over the course of the last 6 or 8 weeks. Now that the banking issues are largely behind us.
Yeah, but looking at the regional banks, you might not know it. I mean, you think they're going to continue to muddle along there, the KRE around 43, 44 a share?
Yeah, I mean, we talked a little bit about this last week, and looking at the banking data, even last week, what we saw was bank deposits actually picked up over the week. The stock prices have rebounded, but we're still at levels that are consistent with where they were right after the SVB concerns, and where there was a real concern that we were going to have a bank run in the system. Those concerns have largely been alleviated. The banks are reducing their reliance on short-term liquidity measures from like the Federal Home Loan Bank overall. And as a result of that, they're looking in better shape on a forward-looking basis. And what we're actually starting to see is those banks are picking up their lending. And so it's pretty difficult to imagine that the banks would be picking up their lending if they were really concerned about a short-term squeeze or a bank run. And all that points to a bit of maybe acceleration over the third quarter in the U.S. economy.